Hey everyone, welcome back to Corporate Decoder. Today, Papaya Growth Opportunity Corp. I just filed their Q2 2025 report, and I am seeing an interesting twist in their SPAC journey. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is burning through cash and has extended its deadline to find a business combination. But there is a significant waiver that changes the financial picture. Alright, let's dive into this quarterly report for Papaya Growth Opportunity Corp. This is a SPAC, a special purpose acquisition company, which means its main goal is to find and merge with another company. They are on a tight schedule to make a deal happen, and filing these reports is part of their public obligation. As of June of 2026, they had just over 8.9 million shares of Class A common stock outstanding. Importantly, they had no Class B shares left, which signals a transition for that type of share. Now, let's look at the numbers on their balance sheet. This tells us what the company owns and owes at a specific point in time. As of the 30th of June 2025, their cash on hand outside of their trust account was a mere $432. That is incredibly low. And the cash held in their trust account, which is meant for acquiring another business, was about $1 million. This is a significant drop from over $8 million at the end of 2024. On the flip side, their current liabilities, what they owe in the short term, were over $10 million. This is a huge gap between what they have and what they owe right now. A large chunk of their Class A common stock, over 90,000 shares, is subject to redemption. This means shareholders can get their money back. The redemption value per S-share is around $11.25. Their accumulated deficit, which is the total net losses since the company started, now stands at a hefty negative $25 million. This shows they have been losing money operationally. When you put it all together, the total liabilities, redeemable stock, and the deficit paint a picture of a company under significant financial pressure. The total of these items is just over $1.1 million, which is much less than their liabilities. Moving on to how they performed financially over a period, their statement of operations. For the 3 months ended the 30th of June 2025, their net loss was over $916,000. For the 6-month period, it was almost $1.8 million. This is a substantial loss for a company that isn't operating a core business yet. The prior year's losses were significantly lower, showing a trend of increasing losses. The number of Class A shares outstanding has also shifted. It was roughly 9 million for the 6 months ending the 30th of June 2025. This resulted in a net loss per Class A share of $0.1 for the 3 months and $0.2 for the 6 months ended the 30th of June 2025. These per share losses were much higher than in the same period of the previous year, indicating a worsening financial performance on a per share basis. This statement shows how the equity sections of the balance sheet have changed over time. At the start of 2025, their accumulated deficit was about $23 million. The deficit grew significantly by the 30th of June 2025, reaching over $25 million primarily due to the ongoing net losses. Interestingly, there is a line item showing a reduction of underwriting fee payable. This is a crucial point. By the 30th of June 2025, the total stockholders' deficit is now around negative $9.9 million. This is a massive improvement from the previous period, mainly due to that reduction in liabilities or equity adjustment. These statements show the actual cash coming in and going out of the company. For the first 6 months of 2025, they used over $44,000 in cash for operating activities. This might seem small, but remember they are not generating operating revenue. The prior year's outflow for operations was much higher, over $800,000. This indicates tighter control on day-to-day spending, perhaps due to the limited cash available. A huge amount of cash, over $7 million, was withdrawn from the trust account for redemptions in the first 6 months of 2025. This is a clear sign that shareholders are choosing to get their money back, which reduces the capital available for a business combination. The financing activities also show a large outflow of over $7 million related to these stock redemptions, further depleting their available funds. The notes to the financial statements are where the important details and explanations are found. So let's dig in. Papaya Growth Opportunity Corp. eyes a blank check company. Its whole purpose is to find another company and merge with it. They need to do this before a certain deadline, or they have to liquidate. They picked the 31st of December as their year end. A massive expense related to their initial public offering, or IPO, was nearly $21 million in offering costs. A big chunk of this, over $15 million, was deferred underwriting fees. These are fees that would normally be paid to the investment banks that help them go public, but they were contingent on completing a business combination. And here is the interesting part. On the 21st of April 2025, the underwriters Cantor and CCM waived their right to that $15.1 million in deferred fees. This is a significant financial concession. Think about it, they voluntarily gave up that money. In exchange, they got some other deal selling their shares. This waiver is a major reason why their overall deficit worsened as presented on the balance sheet. This is standard for SPACs. Shareholders get a chance to redeem their shares if a deal isn't to their liking, as we saw with the cash outflows. They had a stockholder meeting in January 2025 to extend their deadline to find a business combination, pushing it to the 19th of December 2025. This is a common move for SPACs that are running out of time. They recently extended their deadline again, this time to the 19th of December 2026. This shows they are still searching for a business combination, but need more time. Now, what are they actually trying to combine with on the 21st of April 2025? They announced a business combination agreement with Forbes and Manhattan Resources Inc., or FEDM. This is their target. Later, an amendment was made, bringing in Alberta Limited. This suggests a restructuring of the deal, perhaps to accommodate the new entities involved. The outside date for this deal was also extended to the 31st of December 2026. This section is very important for understanding the company's financial health. The company explicitly states they do not have enough working capital and will need to borrow more from their sponsor. This is a clear signal of severe liquidity challenges. Remember that $432 in cash, coupled with a working capital deficit of nearly $10 million. It paints a stark picture. They are operating on very thin margins, if any at all. Management themselves have admitted that there is substantial doubt about the company's ability to continue as a going concern. This is a very serious warning. It means they might not be able to stay in business for the next year if they don't complete a business combination. Let's look at some accounting policies. They are navigating the Inflation Reduction Act, which imposes a 1% excise tax on stock repurchases. For SPACs, this is complex. They have incurred interest and penalties on this excise tax, which are included in their accounts payable. This is an additional cost they are facing. This is where we see how the company interacts with its insiders and sponsor. The sponsor has provided significant loans. There is a $2.8 million promissory note issued in April 2023 and a $1.2 million promissory note from February 2024. These are essentially loans from the sponsor to keep the company afloat. In addition to the formal notes, the sponsor has also advanced them almost $500,000 for working capital, with nothing paid back yet. This shows the sponsor is the primary source of funds. This section covers commitments and potential future events. Here again is that crucial waiver of $15.1 million in deferred underwriting fees. This waiver significantly impacts the company's liabilities and equity. Previously, this was a large obligation that would have been paid from the trust account upon a business combination. By waiving it, the underwriters essentially reduced a potential payout, changing the financial structure. This details the different classes of stock and warrants. They have about 14.3 million public warrants outstanding. These are essentially options for people to buy stock at a set price. These warrants can be redeemed by the company if the stock price reaches $18 for 20 trading days within a 30-day window. This is a typical feature of SPAC warrants designed to either put cash into the company or allow the company to force exercise. Here is management's own take on their situation. They acknowledge they will keep spending money and that there is no guarantee they'll find a business to merge with. Standard SPAC language, but important given their cash situation. They reconfirm the deal with Forbes and Manhattan Resources. This is their primary path forward. Drilling down into the results, they reiterate their net loss for the quarter was over $916,000, with general and administrative expenses being the main driver. It is a lot of spending for what is essentially a shell company at this stage. This is the section that really tells the story of their cash. They plan to use the trust account money for the business combination. Again, that tiny $432 outside the trust account is reiterated here. They explicitly state they need more money, likely from their sponsor. This is the core of their liquidity problem. Without sponsor funding, they may not be able to continue. They remind us of the sponsor loans, the $2.8 million and $1.2 million notes. These are critical for their survival, and the ongoing working capital advances from the sponsor that are not being repaid. Here they discuss their internal controls. They talk about disclosure controls to make sure information is reported correctly. They have identified a material weakness. This means there is a significant chance that errors in their financial reporting won't be caught. Specifically, it was an error in recording income tax. For a company so focused on financial filings, this is a big red flag. This material weakness is about misclassifying income tax payments. This is a concern because it points to potential inaccuracies in their financial statements, even if they try to fix it. The exhibits list agreements and other documents. This confirms the business combination agreement with Forbes and Manhattan. Finally, the signatures of the company officers. These are the officers signing off on the accuracy of the report. So, what is the story here, Papaya Growth Opportunity Corp? I is a SPAC that is clearly struggling to find and close a deal within its extended deadlines. They have very little cash on hand and significant liabilities. The waiver of nearly $15.2 million in deferred underwriting fees is a massive development. It fundamentally alters their financial obligations and potentially their equity structure for the better by removing that liability. However, it also highlights the very precarious position they were in, needing such a concession to move forward. They've got a business combination agreement with Forbes and Manhattan. But that deal has also been amended and its closing date extended. Management itself admits there is substantial doubt about their ability to continue as a going concern and has identified material weaknesses in their internal controls. The sponsor is essentially footing the bill through loans and advances to keep the lights on. The biggest risk I am watching is whether this Forbes and Manhattan deal will actually close and whether it will be a successful combination, given the company's current financial state and the extended timelines. Another thing to watch extremely closely is how much more cash the sponsor will need to inject, and if they will continue to do so. My biggest concern is the low cash balance combined with the going concern warning, even with the target. The research tools I actually use are linked in the description. They help keep this channel going. Alright, that is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.